Don't fall for the small cap stock hoax. Hoax, I tell you. And maybe hoax is too strong a word, but it sounds good and it sells. It's a fallacy. I'm going to share with you what I mean here. First, we're going to define a fallacy, a mistaken belief, especially one based on unsound argument. Sounds like something we had to deal with the last 3 years. Is a belief in something that's going to solve all our worries about various things that are floating around in the air that could really do us harm. Charts like this floating around the Ibison SBBI, stocks, bonds, bills, and inflation. And you always see small cap stocks have dwarfed large cap stocks going back to 1926. This goes to 2010. It won't. It's always the same thing. I'll show you what I'm talking about. It's 2017. So small cap stocks, it looks like, has a 200 basis point earnings equity premium over large cap stocks. It's always the same thing, dude. And it's all based on this from Jeremy Siegel's book, which I'll get into here in just a second. But anyway, the myth is that small cap stocks, they outperform large cap stocks. So you should, I think, what's that guy's name? Paul Merriman talks about this a lot. I don't have any antipathy towards that guy. I don't care. I don't follow him, but I've read a couple things. I've had a number of people who had emailed me this a couple of years ago. They haven't done it lately. I don't know why, but about Merriman. And I was like, wow, I was surprised he didn't recognize the fallacy for what it is. I'm actually not that surprised, to be honest with you. I've been in this business a long time. People just don't read. They just don't. I'm not saying Paul Merriman doesn't read. No, I'm not saying that. But I'm just saying what happens is people see something like this and they say, okay, that's the story. They'll see something just like this. That's the story then. There's more to the story, dudes. More to this story. So let's dive into this. From Jeremy Siegel's Stocks of the Long Run. This is his 6th edition. I got his 5th edition right here and his 4th edition on the shelf behind me. And this was after I think this was after the Great Financial or the GFC of 2008, or was this after the 2000, 2001, 2002 debacle? Can't remember. Let's take a gander, shall we? Should we gander on over and see what this was? This is 2014. All right, so this is the 5th edition. All right, so we're going to go and just, I've done this before, but, I got 77,000 people almost on this channel. The channel's growing by, I won't say leaps and bounds, by steady. So there's new people all the time. All right, so let's check this out here. This on page 177 on his 5th edition. Although the historical return on small cap stocks has outpaced large stocks since 1926, the magnitude of the small cap stock outperformance has waxed and waned unpredictably over those 86 years. A comparison, he talks about comparison here. Small cap stocks, let me just read, small cap stocks measured by the bottom quintile of market capitalization. All right, so we're taking the size of the market, and the market cap is your price, is your shares outstanding times the price per share. That's how you get market cap. Shares outstanding times price per share. All right, so we're taking the bottom 20% of that. That's our small cap thing here. Let's see. So small cap stocks matched large cap stocks from 1926 to 1960. Even by the end of 1974, the average annual compounded return on small cap stocks exceeded that of large cap stocks by only 0.5%. Not nearly enough to compensate most investors for the extra risk, which we'll dive into here. Here's the critical part. Between 1975 and the end of 1983, small cap stocks exploded. During these years, small cap stocks averaged 35.3% a year, more than double that of large stocks. Large stocks averaged 15.7%, small cap stocks averaged 35.3% from 1975 to 1983. Isn't that crazy? Cumulative returns of small cap stocks during these 9 years exceeded 1,400%, 1,400%. Nevertheless, the figure he shows here shows that if the 9-year from 1975 to 1983 is eliminated, the total accumulation in large stocks over the entire period from 1926 through 2006, when this book was written, is virtually the same. You take away those 8 years, and it's basically virtually the same. So you had a freaking huge wave you rode, and if you think you're going to ride that wave again, you're nuts. So what caused the tremendous outperformance of small cap stocks that year? Well, in the late 70s and early 80s, pensions and institutional fund managers found themselves attracted to small cap stocks because of the collapse of the Nifty 50. I'm looking right now, part of my new course I'm working on right now. McDonald's went from a PE ratio of 82 in 1972 to below 9 in 1982. Isn't that freaking nuts, dude? So the price to earnings of McDonald's, for instance, the Nifty 50 stocks, they collapse like you would not believe. I mean, literally, it's nuts. I'm going to my newspapers.com and New York Times. I'm looking, I say, whoa. I mean, literally, the PEs it got destroyed. All right, so the Nifty 50 stocks that were so popular in the preceding bull market just got destroyed. In addition, the enactment of the ERISA, the Employee Retirement Income Security Act in 1974, made it easier for pension funds to diversify into small cap stocks. But as of 1983, small cap stocks had a long dry period that lasted 17 years as they underperformed large cap stocks, especially in the late 90s. Isn't that interesting? Check this out. So my man sent me this article. Oh man, I got a thing in my eye. This is from Business Week, and I'm not a big fan of Ritholtz, but they do some good work. I mean, I don't follow him that much. The guy just rubs you wrong. I don't know. Him and this guy Josh Brown on here. I don't know if Josh Brown still does it, but he used to just this is a long time ago, 6-7 years ago. I was like, he's just dropping F-bombs everywhere. I said, I hate that crap, dude. I hate it. It drives me crazy. It's like trying too hard to be edgy. You know what I'm saying? And and I don't know if Ritholtz does. I don't know. But I do like they got Ben Carlson. I like a lot on this side, on this web. He got his own thing. Ben Carlson. I don't know. I've never heard him interviewed, so I hope he's not dropping F-bombs. I just think I think it makes you look like a weak person if you have to drop F-bombs to be edgy. You know what I'm saying? Yeah, you know, like Owen Benjamin, I like. He's a comedian, so he's going to be edgy and dropping F-bombs. That doesn't bother me. But when you're in finance and you're dropping F-bombs, it's oh gosh, it's so boring. Anyway, so here's going back to Business Week's the death of equities in 1979. I think 1979, right when PEs were about in single digits. And here again, right here. On July 23rd, institutions that manage pension fund money began operating under a new and far more liberal interpretation from the Labor Department of what is a prudent investment under the ERISA. Pension fund money can now go not only into listed stocks and high-grade bonds, but also to shares of small companies, real estate, commodity futures, and even into gold and diamonds. The decision threw the door wide open to hard assets for institutional investors. So that was one of the run-up for gold as well. Don't forget they got rid of Bretton Woods and made it, and so they also made it legal again to transact in gold in the 70s. And then on top of that, ERISA allowed for pensions and insurance companies, all that stuff. Pension money, ERISA plans, I should say, not insurance companies necessarily, but anyone's doing ERISA plans to dabble in gold, small cap, real estate. To millions of people, that ruling could mean a higher return on their pension funds after years of which inflation had nibbled away at the return from more traditional investments, 100%. So check this out. We're going to look at, I got right here. So we're going to compare NAESX, that's the Vanguard Small Cap Index, versus the VFINX, which is the Vanguard S&P 500. All right, so just as a side note, the total stock market index, all right? So we got the total stock market, VTI. I'm not sure how to do this. VFINX. VFINX represents 70% of the total stock market index. I forgot to put an I up there. All right. The other 30% is the small cap index. I'm not sure if they still use the Russell 2000. They used to. I don't know anymore, but I'm sure it's the same thing. So you can see here's a total stock market index. The S&P 500 is 70% roughly of the total stock index. The small cap index is 30%. Of this S&P 500, there's going to be some mid-cap stocks in there, and there's going to be some mid-cap stocks in here too as well, just as an FYI. So you can just split the difference and buy the whole doggone market, which is what I do. That's I have the VTI. I'm a live and die by VTI. So we're going to compare, though, going back to 1985 till the end of basically, maybe April, but certainly March of this year. What did better since those years? That's what we're talking. Almost 30 years, right? Almost 40 years. Yeah, almost 40 flipping years. Total stock index, not total stock index. What did better? S&P 500 or the small caps? Actually, you know what we're going to do here too? Hold on a sec. We'll come back to that. So let's go here, and we got That's the Vanguard Small Cap Index. That's the Vanguard S&P 500. We put 10,000 schmackaroonies in each in 1985, when it was January 1985 until April 2023. All right. We got the S&P 500 did 11.08% a year. Compounded annual growth rate. Small caps did 9.76. Standard deviation much higher on the small cap than on the large cap. Best year was much higher, which is interesting. Look, best year on small caps was much higher. The worst year was actually lower. Isn't that interesting? But the max drawdown was higher in the small caps from June 7th to February 2009. So it just shows you some of the standard deviation, the kind of statistical models don't make intuitive sense. But the best year is higher, significantly higher than the S&P 500, and the worst year is actually lower. And yet the max drawdown, i.e. the real risk that matters, was higher. And I wouldn't say significantly, but it was about 6% higher than it was in the S&P 500. So what did better? Well, there you go. S&P 500 at 10,000 schmackaroonies in 1985 is worth $532,000 now. Small cap was $372,000. I mean, that's a $150,000 difference. And yet people are still going to go and say, look, small caps do better, Josh. It's proven. Look at that. Look, all over the place. And I'm just telling you, it's an error. It's a fallacy. It really is, man. And I mean, it's just, unless I was going to add VTI in there to kind of split the difference here. But I can't do VTI. I've got VTSMX. And I can't remember how far that goes back. It doesn't go back to 1985. I know that. I think 1994. Let's take a look. VTSMX goes back to 1993. There you go. And that should be in the middle between the two. Let's see. So small cap 159, S&P from 1990, was that 1994, 1993. So small cap S&P 500 did 167,000. Large cap, that's the large cap. Small cap did 159. VTI split the difference 100%. So a lot of similarities there. Look at that. A lot of the same drawdowns, a lot of the same best years. A lot of standard deviation is still much higher on the small caps. So let's go back to the last 10 years. I bet the last 10 years, large caps is significantly better, which would make me say, maybe there's some opportunity for small caps now. I don't know. I don't think you should mess around with that. I think you just buy and be done with it. But what's this? What's the blue? The blue is small caps. So yeah, small caps over the last, since 2000, have smoked large caps pretty significantly, actually. Look at that. 8 roughly to 6.5, yeah, and still have the same risk roughly. So now we go back to 2009, which I bet small caps did worse since the last 15 years. So let's take a look. I bet I'm going to be right. Yeah, I am. Pretty close though, man. Pretty. I mean, look at that. 12.32 in small caps, 13.36 in large. But yeah, you can see the difference there. Small caps getting knocked around here this year so far. Large caps coming back off the bottom here that we had. But anyway, the issue is when you see these things, and this is what the thing that's frustrating with me about Siegel. He basically said if you take out those 8 years, you'll get a track record that these guys mimic each other. And I 100% agree with that. But the interesting thing is what Siegel should also know to do is take out the years of bonds, right? He only uses government bonds. That drives you crazy. So basically from 1948 to 1978, the market of bonds actually was negative. It didn't make any money. And so if you take out these 20 years, bonds and stocks, they don't look nearly as bad as what this chart would show you. So basically, I'm not going to show it to you. Well, maybe I can. Also. Right now, my man Ed McQuarrie over at Professor Emeritus at Santa Clara University, he had written this piece, which I read a couple years ago, and I read it again just recently, and just it's interesting. What didn't kick in a couple years ago is kicking in now. And he talks about this phenomenon right here. He goes, can the huge advantage of stocks over bonds piled up between 1946 and 1968 ever be diluted away? And the answer, of course, is no, as we could just see by this right here. The huge run up from freaking small cap stocks from right here, these small caps to right there, can never be diluted away until it reverses where the large cap stocks absolutely outperform small for, we're talking 1,400% for small cap stocks, which is more than double that on an annual basis of large cap stocks in those 6 years, 7, 8 years, something like that. Same thing here from 1946 to 1968. Same thing happened with stocks over bonds. Once you have that significant of a trajectory, just shoops to the moon, and something just kind of not doing that, you're not going to be able to recoup. The laws of large numbers at that point kicks in, unless something really goes wrong with small cap stocks or stocks as a whole relative to bonds. And I'm not expecting that. But anyway, it's just pretty interesting because you can't recover that. In fact, I think Ed talks about it. I don't have it up here. I'll do another video on that. But he uses not just small cap stocks. He uses other things where it doesn't matter what you do going forward because of the massive, massive amounts of returns that you had in that one category relative to this category for even a short amount of time, like small cap stocks versus large over 8 years. It's going to take a freaking nasty fall for small cap stocks to even have a track record equaling that of large cap stocks going back historically. That's how much of a bull run it was for small cap stocks. Same thing for stocks over bonds. You'll never get that. It'll never be that. So anytime you see these Ibsen charts, it's always going to look like stocks outperform bonds. If you take out that 20-year time frame, though, it doesn't. And so you take unless you were in that stocks versus bonds, that 20-year time frame, it's not the same, dude. It's not. And Ed talks about that in his article. Anyway, I'll put a link to that book if you want. Jeremy Siegel's. It's a good book to have, dude. There's a lot of stuff in there. It's great. He challenges Siegel in some regard. Ed does. I like. But Siegel's stuff is good. It's good first-class research, and it's an interesting read, and I think you'll get a lot out of it. So you definitely should buy the book. And love to hear your thoughts. Don't forget to subscribe to my doobie-doo down below. If you like, once every Friday at 4 p.m. Eastern, we go live on Locals Only. 5 schmackaroonies a month, dude. You can contribute. You can see the live streams. You can add stuff. I'm a big fan. So join me there, too. We'll see you.